Hello there. If you're a director of a UK business, I need your attention because a massive change is heading our way in 2026. It's going to put your finances under a microscope like never before, thanks to some powerful new tools HMRC has. So, the real question is, how do you stay compliant and avoid a really costly investigation? Well, let's break down exactly what you need to know.
Now, everything we're about to cover comes directly from the expert tax advisors at My Tax Accountant. These are the folks on the ground working with directors every single day, helping them navigate these exact rules, so you know you're getting advice straight from the front lines. Just look at this number for a second. 4.6 billion pounds. That's not a company's profit. That's how much underpaid tax HMRC's powerful AI system, known as Connect, clawed back just last year. You've got to think of it as a digital detective that literally never sleeps, and believe me, it's getting smarter by the day.
So that brings us to the most important question for any director, right? With that kind of technology, digging through every bit of your data, how on earth do you make sure your business stays off its radar? That is exactly what we're going to get into right now. Okay, here's our roadmap. We'll start with HMRC's new digital detective. Then we'll walk through the 4 biggest red flags: unexplained money, the director's loan trap, risky expenses, and dodgy paperwork habits. And we'll finish up with a clear, proactive plan to get you ready for 2026. Right, let's get into it. Section 1, HMRC's new detective. Look, if you still think tax investigations are about random spot checks, you need to know that the game has totally changed. It's no longer a case of if they'll find something, but when. The system driving all this is called Connect, and it's not just a simple program. It's a seriously sophisticated data mining platform that works 24/7. Its entire job is to spot patterns, find anomalies, basically anything that suggests tax isn't being paid. It's constantly sifting through billions of data points to build a complete financial picture of you. And what's wild is just how much information Connect pulls in. We're not just talking about your business bank account. It's looking at your personal accounts, data from Stripe and PayPal, and even your overseas accounts. It then cross-references all that with property records, DVLA info, and, get this, even your social media. Yeah, that amazing holiday you posted about online, Connect can check if your declared income actually supports that kind of lifestyle.
Okay, let's dive into our first major red flag. And honestly, this is the number one thing that triggers an investigation. Unexplained money just landing in your bank account. This one catches so many people out.
So here's the bottom line. If you can't prove with solid evidence where a deposit came from, HMRC's default position is to assume it's business income you haven't declared, and they will tax you on it. Imagine a tech startup in Birmingham. The director's dad lends the business 20 grand to help with cash flow. If that transfer isn't clearly documented as a loan to the Connect system, it just looks like £20,000 of untaxed sales, and you can guess what happens next. So here's my tip on how to protect yourself. First, and this is non-negotiable, keep your personal and business bank accounts completely separate, no exceptions. Second, anytime personal money goes into the business, document it immediately. Label the transfer clearly, loan from dad, and get a simple loan agreement in place. And finally, just never mix your trading income with other funds. Keep it clean. Right, on to red flag number 2, the director's loan account, or DLA. Now, this can be a really flexible and useful tool for business owners, but it is also a massive tax trap that catches out countless directors every single year. The only number you need to remember here is this one, 33.75%. That's the painful rate of tax. It's called Section 455 tax that your company has to pay to HMRC if you take a loan from it and don't pay it back on time. And notice I said your company. This is a hefty tax bill for the business, all because of a missed deadline. And this shows you exactly how it works. So at your company's year-end, if your DLA is overdrawn, meaning you owe the company money, a clock starts ticking. You have exactly 9 months to repay that loan in full. Do that and you're golden. No taxes due. But if you miss that deadline, even by 1 day, that 33.75% tax bill is triggered automatically. There's no wiggle room. And here's a little insider tip for you. Don't think you can game the system. HMRC is wise to this stuff. Let's say you repay a loan of, say, £20,000 just before the deadline, and then you take out another £20,000 a week later. They can just disregard that repayment. It's called a bed and breakfast arrangement, and it shows they're looking for a real, lasting repayment, not just a temporary fix to dodge tax. Okay, let's talk about our third red flag, business expenses. Now, this is an area where perfectly honest mistakes can cause some pretty big problems because the rules, especially around things like entertainment and VAT, can be really confusing. And this slide right here clarifies one of the most common mix-ups. Let's take a cafe owner in Manchester. If she throws a Christmas party for her staff, as long as it's under £150 a head, the cost is an allowable expense for tax and she can reclaim the VAT. Simple. But if she takes a client out for lunch, that's client entertainment. The cost is not an allowable expense and the VAT cannot be reclaimed. Getting these two mixed up is a classic red flag for HMRC. And here are a few other quick-fire mistakes to watch out for. You can't claim VAT on UK flights or train tickets. They're what's known as zero-rated. A lot of people get that wrong. Next, if your director's loan goes over 10 grand, the company must charge you interest. Otherwise, it becomes a taxable benefit in kind. Also, just be sensible with travel. HMRC will definitely question a claim for a 5-star resort unless you can prove it was absolutely essential. And of course, no valid VAT receipt means you can't reclaim the VAT. Simple as that. Our last red flag might seem like the simplest one, but it sends the loudest signal to HMRC. Your filing habits. Whether you're on time or always late, tell HMRC a whole story about how organized and compliant your business really is. See, the Connect system is built to spot patterns. So if you're constantly filing late, or you have to go back and amend your returns all the time, it just flags your business as high risk. In fact, just 2 late VAT returns in a row can be enough to trigger a check. It just suggests your records are a mess, which makes HMRC wonder, what else might be wrong? Stay with me. This next point affects every single director in 2026. Now let's look at what's just around the corner. A major change is coming in 2026. And this isn't just some small tweak. It's a fundamental shift in how directors are held accountable. It's called mandatory director ID verification. So under these new rules, every single company director in the UK will have to have their identity digitally verified. This creates a direct, unbreakable link between you as an individual and the company you run. It makes it so much easier for HMRC to connect the dots between your personal tax and your business tax, making complete transparency an absolute must. Honestly, this is a game changer for director accountability. So we've talked about all the risks and the tech that HMRC is using. Let's flip this around and talk about the solution. How do you build your defenses so you can operate with confidence? Here's a proactive plan to give you that peace of mind. So my final tip is all about shifting your mindset from year-end panic to a state of continuous calm compliance. Reconcile your director's loan account every single month, not just once a year. Use software like Xero and apps like Dex to keep your records perfect in real time. If you're paying dividends, hold a proper board meeting and keep the minutes. That's your proof. Before any return gets filed, just look at it. Ask yourself, does this make sense? And crucially, as soon as that new Director ID system is live, get yourself verified. The key takeaway is this: if you are ever in doubt about anything, ask an expert before you act. Staying ahead of these changes is absolutely vital. If any of this has raised questions or you just want advice tailored to your specific situation, the team at My Tax Accountant are ready to help. You can call them on 0208 570 8531 or drop them an email at info@mytaxaccountant.co.uk. Just a quick disclaimer before we finish, the information here is for general guidance. Tax is complex and your situation is unique, so you should always seek professional advice before making any financial decisions. Thanks so much for watching, and please do subscribe to the My Tax Accountant channel on YouTube for more essential updates for UK business owners.